everyone. Welcome to our fifth and final session of the new Land Trust Board Member Bootcamp. This session, of course, is on financial management. So without further ado, I'm going to go ahead and pass this on over to Connie.
Hi, everyone. So I think I know so many of you, and thanks to those of you who have been at, some of the previous 4 sessions that we've had. Just by way of a very brief introduction, I come to you I wear many hats in the land trust field, and tonight I'm wearing my hat of being on the advisory council of CLCC. I've worked for many, many years with now Rebecca and Amy on putting together some of the training programs for CLCC, and I'm so pleased that I've gotten to know so many of you through that work. I'm based in Kent, Connecticut. I serve part-time, 20 hours a week, as the executive director of the Kent Land Trust, and I also coordinate the Litchfield Hills Greenprint Collaborative, which is a regional conservation partnership of about 33 conservation organizations. And in addition, I often consult for the Land Trust Alliance. In fact, I serve as the circuit rider in the state of New York on, areas of the standards and practices, conducting organizational assessments, helping land trusts through the process of accreditation, strategic planning, and other manners. So I'm going to launch my slides, share my screen with my slides here. Always hard for me to both talk and do that at the same time. Just a little bit more housekeeping. Again, we have kind of a full room, so I would ask that you mute yourselves unless you're talking. And since we continue to miss the very important function that meeting in person plays, which is, to connect with each other during break times and before and after the session, I just want to encourage you to use the chat box to correspond with your peers, answer their questions. If a question is posed that you know the answer to or have, something to contribute, feel free to privately message them if you know somebody. All of that kind of interaction is really helpful, and we want to encourage it. So, and again, if you don't mind, please, and if you're just joining us, please rename yourself so both your name and your affiliation is visible on your box. Okay, and I think, Rebecca, that you mentioned that we were recording these sessions with the intention of posting them on the website. So I just want to, again, make you aware of that. Great. Well, again, as a quick review, these bootcamp sessions follow along with the format of the Land Trust Standards and Practices, which are a body of guidance compiled by the Land Trust community and conservation professionals, which is codified and maintained by the Land Trust Alliance, which is CLCC's national counterpart, providing advocacy and supportive training and services to conservation organizations nationwide. The standards and practices were last updated in 2017, and they are comprised of 12 standards that address important and shared common topical areas of land trust practice. The first half of the standards and practices pertain to all nonprofit organizations, and the latter half are specific to land trusts. And the standards also easily organize into 4 topical buckets. Those are governance, financial management, land transactions, and stewardship. And over the past 4 weeks, we've looked at governance, land transactions, and stewardship. The standards tonight addressing financial management are primarily found in Standard 6, but are sprinkled here and there in the governance-related Standard 3, and also in the Standard 5 concerning fundraising, and a little bit in Standards 11 and 12 related to stewardship expenses. Okay, by way of review, why are we back here in Standard 3 about governance? Because while it is the bookkeeper, the staff, the treasurer, the finance committee, or some combination thereof that is likely doing the work of financial management, it is ultimately true that the full board is legally responsible to make sure that the organization is financially stable and sustainable, and that means the board should be setting and having knowledge about the annual budget, a budget that should be balanced in the black and allowing the organization to build resources instead of engaging in negative spending. In order to do this, the full board should receive regular financial reports at a frequency that is appropriate to the organization and presented in a format that allows each board member to understand the financial status and be able to discuss this during meetings as necessary. We're going to go much deeper into reports. The full board should, usually with the help of the Finance Committee or an Audit Committee, receive and review a copy of the annual audit or review. And the board should be involved in setting policy regarding the investment and management of its reserves. Some of this, in fact, much of it is addressed in a more detailed fashion within Standard 6. So let's press on. Okay, the first practice within Standard 6 is about the budget. While the budget is often, as I said, developed by staff or committee chairs, maybe the treasurer, maybe the president and the finance committee, each year the board should receive a draft budget for its review and adopt it within a meeting. Recall from our session on governance, the concept of the budget as one component of that three-legged stool, which works together with the annual work plan and the fundraising plan. In your board role, you should be making sure that the budget contains anticipated expenses for the activities that you may be responsible for. I put a note on this slide because I'm often asked about the timing of fiscal years. Many land trusts use the calendar year, which is January to December. That makes it pretty easy to track. However, some have moved to a mid-year calendar, maybe going July to June, and I've also seen October to September. The decision usually comes down to periods of cash flow and personnel resources. For example, many of our organizations do an end-of-year appeal, which can result in income that spans the calendar year and makes it difficult to assess and compare membership income year over year, because you'll always have parts of two campaigns in each year. Some money will come in December, and some money will come in January and February thereafter. Likewise, organizations that rely year over year on grants when the activity happens in one year and receipt of the funds happens in another may wish to adjust to make accounting easier, as well as make it easier to understand the organization's financial status and to present that to third parties if that's something that your organization does. I have a note on this slide about accounting software. Anecdotally, these are questions that I anticipate tonight. Anecdotally, I would say that most Connecticut land trusts are using QuickBooks. If you'd recommend any others, perhaps put this in the chat. Accounting software really, to me, is pretty much a must today, and it makes the reporting that we'll talk about so much easier. So if that's not a transition that your land trust has made, I want to put a plug in that you consider it. With this first practice of Standard 6 also comes the warning that a board should not let a trend of deficit spending deplete its reserves. We need to plan for perpetual life. So if this is an issue, the organization needs to be cognizant of that and upfront about it and make a plan for what they're going to do in order to reverse that trend. And the board should be thoughtful with regard to its ongoing income sources to ensure stability in case one or more of its usual sources becomes temporarily or permanently unavailable. Some of us experienced this firsthand last year when we couldn't host our usual in-person fundraisers. Over-reliance on one source can leave an organization vulnerable. So it's important to have a good understanding of where the organization's money usually comes from and what alternatives might be in case one or more of those become untenable during a certain year. Personnel-wise, an organization with a ton of activity in, I'm going to go back for a second. I must have skipped over it in my notes. Let's put a period on talking about sources of income. And I'm just going to put you back to the fiscal year for a second, because I did say that these decisions are largely linked to the timing of your cash flows, but also can be linked to, personnel busy times within your organization. So if your organization has periods that it knows its personnel are always going to be busy, whether that be boarders or staff, maybe if you have a ton of activity in the springtime, together with Earth Day, you might want to adjust your financial year to avoid also having the press of audit season in that March to May period. Okay. To avoid crises, we're still in the practice A of Standard 6. To avoid crises that are related to loss of an income source or a negative spending year, the first practice of Standard 6 is also about building reserves, and those include operating reserves, which are unrestricted funds that can cover regular operating expenses. The best practice is to have at least 3 months worth of unrestricted operating reserves, so 3 months worth of your normal spending accessible to meet operating needs. For many organizations, the operating reserve is simply the main bank account. Invested unrestricted funds can be considered an additional reserve for operating needs. In addition to operating reserves, you also should have stewardship reserves because we need to take care of our easements and fee properties in all of the ways we discussed last week forever. How would we know how much we need for stewardship reserves? As we touched on last week, there are a number of tools and guidelines, and ultimately we should look at each new property to assess and estimate its unique risk and needs. So for defensive properties, the Land Trust Alliance, as a little bit of review, has developed using actuarial data from the Terra Firma Conservation Defense Insurance Program, a calculator that takes land trust properties, experience, and demographics into account in providing a suggested amount that it should have on reserve. For monitoring of properties, your internal analysis of what you might need on reserve should not assume, if you're using volunteers to monitor, that you'll be able to continue this with no personnel expense in the future. So it's a better practice to track the number of volunteer hours contributed each year by monitors and base your reserves on what might be needed if you had to pay a contractor or staff to do this instead. So take that time calculation and assign a per hour number to it to give yourselves a good estimate of what you might have to pay if you did not have volunteers. Note that for accredited organizations, reserves must meet the level of at least $3,500 per easement property for monitoring. Defense is separate. Here quickly is a look at the Legal Defense Reserves Calculator. You can get to it from the Land Trust Alliance Learning Center as well as through Terra Firma's website. And I put these links on the slide, but Rebecca, maybe you would post them in chat so people can copy them easily.
Yep, will do.
Okay. Or you know what? Maybe send a follow-up so I can advance the slide. What's easiest?
I can put them in chat right now, and they'll come to you by way of follow-up via email as well.
Okay, because I'm going to go forward.
Perfect.
Okay, thank you. The remainder of Standard 6's practices are not as dense as that first one. Practice B is about using an appropriate basis of accounting, GAAP, which is generally accepted accounting practices, or the fun to say ACBOA. Basically, advising that using an accrual as opposed to using a cash basis method is more effectively presents the organization's financial situation with respect to the funds that are available, as well as the future expense obligations of the organization. For the purpose of financial reports and record keeping, it's also important to know whether assets have been committed for specific purposes. Some funds may be donor restricted, maybe even forever, as in the case of a true endowment where the funds are meant to earn income that is then reinvested and the principal never gets touched. Some donor restricted funds are restricted in terms of when and on what they can be spent on. So that's more of like a purpose and time restriction as opposed to a perpetual donor restriction. All donor restricted funds are now presented by auditors as DR, donor restricted, and they have taken away the categories of temporarily restricted, TR, and permanently restricted, PR. But it's important for boards, at least internally, to understand their donor restricted funds and how they impact what is available to the organization for its use and under what circumstances. This slide goes back to Standard 5 on fundraising somewhat to remind us that when donors make gifts for restricted purposes, this should be made clear within the organization's documentation of the gift, including its thank you letter and its bookkeeping associated with the gift. I have language on this slide about what goes into a donation thank you letter, which is otherwise known as a tax acknowledgement letter, recognizing that composing and sending these letters is usually a function of one person, not the entire board. I'm not going to spend a lot of time on this, but I do invite your questions when we pause, if you have any. Okay, to round out our discussion of unrestricted versus donor-restricted funds, you might hear about organizational funds that are board designated. In other words, funds that are not restricted pursuant to a donor stipulation, but for which the board has decided together might be best earmarked for potential future expense needs. It's a common practice, for example, for stewardship reserves to be comprised partially or exclusively of board designated funding. And many boards have set aside what they call strike funding to provide for acquisitions related expenses when time is of the essence. Periodic financial reports to the board, and this may be every meeting, quarterly, perhaps even semi-annually, depending on the size and scope of the organization's activities, should be provided in a manner such that the board can know whether there are adequate funds on hand to implement the budget and provide for future solvency. So these reports would usually include a balance sheet that indicates not only asset values, but also the allocation of these assets among unrestricted, board designated, and donor restricted funding, a statement of activities, or a profit and loss statement, showing the organization's performance within a certain period. And it's helpful to present both reports with comparison information. It's also typical to do this, to provide context and further insight to the rest of the board. So for example, the balance sheet might include a comparison against the end of the last fiscal year, or a comparison with the prior year as of that same date. The P&L might include a comparison versus the prior year and or a comparison against the budget to show how you are progressing towards your budgeted goals. Usually the treasurer would review the reports in the context of a board meeting with the report and discussion included in the minutes. It may be additionally helpful for the treasurer to provide a cover memo, depending on the complexity of the reports, calling the board's attention to significant details that they might want to discuss or just take note of. All right, while we're back in Standard 3, we're going to just take one last detour and make a quick note on the policies for investment and management of funds. There are templates for these, which can be more or less complicated depending on the organization, the amount of its unrestricted assets available for investment, donor restricted assets left to the organization's management, and the status of any board designated funding. But whatever the organization's unique situation, some factors to consider usually include the organization's prospective need for the funding, which will determine its need for liquidity. A good example of this is with board designated reserves for acquisition strike funding. This would need to be easily accessible in emergent situations, and so shouldn't be in a long-term investment where you would be penalized for taking it out early or might not be able to get your hands on it at all. And sometimes community foundations have more bureaucratic processes for requesting funds, so they are probably also not as appropriate as some other methods for investing funds that you need to get your hands on, sometimes in a real hurry. The organization's level of risk tolerance is another factor. Some board members are more experienced with investment management than others, and it should be noted that no matter what, nonprofit organizations are usually a little bit more conservative due to their fiduciary role of stewarding public funds. And land trusts in particular take a very long view in terms of their investment return because they're really planning for forever. Okay, we're going to take a breath and pause for any questions. I have not been seeing the chat, so I'm going to open it up. And Rebecca, if you want to let me know if any have come in.
Yeah, so we did have a question from Hank, and I see that Dennis from Avalonia provided a couple of answers, but I'm still going to run this one by you, Connie. So Hank's question is, what level of detail does the annual audit or review need to be?
Well, so those two different instruments vary quite a bit. An audit is always going to be the most detailed, and at least my experience with my auditor is that they really look at each and every single transaction. However, even if one is getting a review, the report should be provided with footnotes or endnotes that explain some of the positions and the business of the organization, and go into a little bit more detail on classifications of donor restricted funds. So, so in terms of, I guess the value out, I would say an organization that has a fairly large, a fairly large scope of activity over the course of the year and a pretty big budget is probably going to get more out of, obtaining an audit as opposed to a review. However, with that level of detail certainly comes a lot of expense. And so an organization that has a much lower level of business over the course of the year, and depending on the organization's level of funding, may not want to, and may not think it's prudent really to, to pay upwards of $10,000, say, for an audit when they can get by with just having a compilation or a review. And of course, the Accreditation Commission sets the levels that are required based on the income, the organization's annual income. Any others?
I don't see any others. Dennis just noted that the single audit must be filed no later than 6 months after the end of the audited period. So thanks, Dennis. But no, I don't see any others coming into the chat right now.
Yeah, and actually, I thought I had those. I have something on this in my notes, but what Dennis is mentioning, the state single audit is actually a requirement for some organizations when they receive a certain threshold of money from the state. And so organizations, even very small ones that might not typically get an audit, may need to, in a given year, depending on their receipt of funding from the state. And OSWA is a situation where that might happen with an organization, depending on the property acquired and how much money is received from the state. So, and I see that Dennis is saying it's 300,000. I actually thought the threshold was a little bit higher, but certainly, and it changes from year to year too. So I would recommend that if you are receiving a large chunk of money from the state in connection with an OSWA project or any project, check the level so that you can make sure that you meet the state's statutory requirements. The other thing that I can say about that is, now that I've touted the benefits of having an audit, if there's going to be a year when you need a state single audit, that's a good year to contract for, the one-time audit that you'll get great information back because you have to do it anyway. And so for organizations with a smaller level of annual income, you might consider, waiting, especially if you're going to receive a chunk of money from the state. You might put off getting an audit until the year that you're going to have to do the state single audit, because you will have that expense whether or not, it's not your choice anymore, I guess is my comment. So, all right. I just see, before we move on, I'm looking at Deborah's question. I'm looking at revising the chart of accounts for the land trust I'm with. I'm wondering how other land trusts track their expenditures for property by expense type or both, and would it be possible to share charts of accounts between members, and Suzanne's interested in that too, as am I. I mean, I think that is like way beyond the scope of our, our high level overview today. But we have found CLCC, that is, we've had focus groups with treasurers in the past and spent a good amount of time talking about how to organize a chart of accounts and whether there's a model or, what we can learn from each other's experience, basically, of how we've categorized things in QuickBooks and otherwise. So if you want, sorry, go ahead.
No, I was just going to quickly mention, as you said, and I'm glad you brought that up, we do have focus groups from time to time. They're not, we don't always have the treasurers meet every single year, but if there is something like that you're really interested in, please send me an email. It's really, really great for us to be able to gauge that for our programming. So thank you.
Terrific. Okay, we're gonna move on, but we will break again for questions, and we're going to have small breakout groups towards the end of this. There's time, so here we go. And I'm just going to close out the chat so I can see my slide. All right, more on the audit. I knew I had a slide on this. The next practice, which is practice C in Standard 6, involves the annual review, which should be in all cases conducted by an external and independent accountant. Whether you get one or the other of these different kinds of reviews really depends on the size and the scope of your organization. Smaller organizations are usually not required to obtain a full audit, the expense of which would probably not be justified given the number of transactions over the course of the year. As we noted, there's a threshold above which the state might require an audit, which occasionally may require even a small organization to obtain an audit, and accreditation requires organizations to get an audit, review, or compilation at certain levels of annual income. Usually it's the Finance Committee which is going to deal with retaining and corresponding with the accountant during the preparation of the report, and then when the report is complete, it should then go to the board for its own review and for acceptance. The board's review will include review of the notes, which provide additional detail on funds that are donor restricted or board designated. The report might include, especially with an audit, a governance or a management letter that will identify any deficiencies that need to be addressed. In terms of the board's review of the audit, occasionally the auditor might issue a governance or a management letter that would identify deficiencies that need to be addressed by the organization. One of those, an example of that might be a lack of internal controls that creates like a high risk of misuse or misappropriation, and the organization should take action to respond to these concerns, and they should document what action they did in writing and return that to the auditor, stating the corrective action that they've taken. Often, the annual IRS Form 990 tax return is completed in conjunction with the annual audit or review. And this is because organizations might wish to wait until the audit is final to complete the 990 in case any adjustments to the books are needed. A recommended process for the 990 includes distributing the draft to the board for its review, discussion, and then finally having the board vote to authorize the filing of the 990. Board minutes should reflect the board's review of both the audit report and the draft 990 and the vote to authorize the filing of the 990. Okay, moving on. What does it mean to have internal controls in place with respect to financial management? It means that organizations should really think about their own unique financial risks that are associated with, for example, theft and misappropriation. An example of that might be payment of an invoice for work that didn't happen, nightmare. Misuse of funds due to mistake or miscategorization. So, this might be the wrong person gets paid, or donor restricted funds are spent on something they shouldn't be used for, are good examples. Misallocation or mistakes in reporting funds, and these would be errors in bookkeeping or reporting. and loss of funds, such as when a donation check is misplaced or destroyed, or simply buried in a drawer somewhere. Here is an issue that, again, can vary with the size and the scope of an organization. So, I just want to recognize that small or all volunteer organizations don't have the depth of personnel that a large organization with an HR or a finance department would have. And organizations dealing with smaller levels of assets, the magnitude of risk may not be quite as large as organizations that are typically dealing with much larger magnitude of assets every year. But regardless of the size of the organization, internal controls are about building in checks and balances so that more than one person touches each income and expense transaction. I've listed some common strategies here for income-related checks and balances, such as having one person get the mail and another open it, and building in systems where donations are reported to certain people in the organization in addition to being processed and compiled for deposit in the bank. Another strategy often used is implementing periodic and independent reconciliation of bank accounts as a way to keep checks and balances on the income coming in. For expense-related checks and balances, ensuring that the person that ordered the work on invoices presented for payment okays the invoice before it's paid. So here is a situation where, depending on who contracts for the work, you want to build in the opportunity for at least one other set of eyes to touch that. The person who ordered the work says, yes, go ahead. This work was done, I authorize the payment, and then somebody else actually orders and makes the payment. And again, for expenses, enlisting more than one person to conduct regular reconciliation of the bank statement against the internal bookkeeping is a good way to just make sure that time doesn't go on, on and on and on without a mistake being identified. Another simple check and balance is using two people together to count cash receipts at the end of an event that collects cash. Okay, so I think that what we wanted to do is just kind of, hear from you what kinds of issues you were talking about in your breakout rooms. We have, as it turns out, there were only 2 slides left. So rather than, worry about doing the order, we'll do your concerns and questions now, and then we'll quickly go back at the very end to the last 2 slides. So Cheryl, you have your hand raised.
Okay, I'll put the other one down. Okay. So tell me about accreditation. So do we have to get reaccredited? Or
yes.
By filing 990N, is that the way you get accredited?
Oh, no, it's a totally different thing, Cheryl, and something worth learning about if that's brand new to you. Accreditation it's an independent program and a voluntary program for land trusts, and it all relates back to the standards and practices that I have been describing to you over the course of this. But it is not, although there is financial management stuff in the accreditation program, it is not related to, nor does it replace, your requirements to file a 990 and to have a review or a compilation or an audit now and again. Anybody else want to share what they were talking about in their small groups?
The question came up about sales and use tax, if you have to pay sales tax if you sell T-shirts or things like that.
Ooh, that's a good one, and I have to say that I am not the expert on that. When I have touched on it, very superficially, I have thought about, the unrelated business income tax and whether or not your activity relates to your central mission. And so, an example of this, this is definitely something that you would want to discuss with your accountant. And, perhaps if you're not the treasurer or on the finance committee, within those bodies within your organization. But just the same way that museum gift shops often are selling stuff that is related to the exhibits that they have inside the museum, there are ways, and I don't, if you're selling a t-shirt with Mickey Mouse, probably not, but there are ways that your merch can be related in some way to your mission. But this is a question for your accountant or your auditor.
Because I also recommended the Department of Revenue Services has a pretty thorough website for the state, checking on their website or calling and asking them as well.
Good ideas.
Looks like Rick Newton had posted a response to that here in the chat as well. He says you can do 5 free sales tax events per year on sales tax.
Yeah, and Dennis talking about different kinds of swag that you can give out each year with, and that is in connection. His comment is in connection with donations. So this is the situation where a donor gives something, and you send them the shopping, the tote bag, or the other merchandise. So the IRS does have really good guidance for things like this if you want to try and do some research on your own.
Connie, I didn't want to miss a question in the chat from Gary. He asked, what type and amount of insurance do you require when hiring contractors, and how do you verify the policy they present to you?
So in terms of verification, I don't know that I would go that deep. I would ask for a copy of their certificate of insurance, and the certificate of insurance should have the dates of coverage on it. And so you would know if it was current or expired. I haven't seen anyone forge one of those yet, although I think, maybe it's possible. In terms of the amount of insurance, generally, I would probably look for $2 million if I could. $1 million might cover it, and some of that depends on what you're hiring the contractor to do. So if you're hiring, an arborist who's going to cut down trees for you, $1 million might not be enough, but something that you can talk with them about. They're probably more up on their own needs for insurance, including workman's comp, than you are. So those are some things that I would look at when deciding. Oh, and Gary says that he's seen them cancel the policy after getting the job. Yeah, I don't know. Maybe I am just like an eternal optimist. I can't even imagine. But I would hope that particular contractor, that they're going to have a hard time finding new jobs if word gets around that they've done something like that. Yeah. And Anne has her hand up. Anne, can you take yourself off mute, Anne Westerman?
You're talking to me? I didn't put my hand up. But
oh, well, it's up.
Like on my screen somehow?
Uh-huh.
It doesn't show up at my end, and I don't have a question, so sorry.
Okay, fine. So, and Amy says, report that contractor, for sure. That's lousy. Okay, so anybody else, any last questions? And then I think we're going to just move very briefly to these last slides. And as before, we're going to end pretty much right on time. But if anyone has any lingering questions, I can stick around for a moment or two more. All right, I'm going to go back and share my screen. And here's where we were. And we'll move right into risk management and insurance, as long as we are on that topic anyway. There will always be risks that cannot be fully avoided or mitigated by a prudent investment, internal controls, and the best board oversight. And for this reason, and I'm talking about financial risks here, Standard 6 also covers insurance. Land trust boards should be knowledgeable about what insurance coverage they have and periodically review this to ensure that they're adequately covered. For accreditation, this review should be documented and occur at least every 5 years, which coincides, of course, with the accreditation renewal term. So, basically, some of the things that you should look for is every organization should have general liability insurance, which is going to cover losses that are related to property or events and have usually your umbrella policy. It should have directors and officers insurance, which protects you and also can cover volunteers that are acting on behalf of the organization. Many land trusts get these first two general liability policies and their D&O through Chubb Alliant, which offers a package that is specifically designed for land trusts. Comes out of Washington, D.C. Employers should have unemployment and workers' comp insurance. Sometimes that comes from your payroll provider. So sometimes organizations arrange for that through the payroll company. I, through the Kent Land Trust, purchase workman's comp through Chubb Alliant. So Chubb Alliant does offer that as well. And an organization should at least consider whether conservation defense insurance would be helpful for it through Terra Firma. And Terra Firma, which has an enrollment period around the turn of the year, I think it's usually the very beginning of February each year, can be purchased to cover one's easements and one's fee properties, or either or, but you can't pick and choose your properties that are more likely to have encroachments or lead you into liability for title suits and things like that. All right, we're not going to pause. We're going to skip right to the top 5 takeaways for new directors and seasoned treasurers. And those are to make sure that you receive and review regular, understandable reports, including information on assets and activities to help understand whether the organization has the resources it needs to carry out its annual activities and sustain itself into the future. Number 2 is be responsible for honoring donors' intentions and pay attention to donor-restricted funds. So when something is given to you for a specific purpose, make sure that you have systems in place, and there will be a lot more on that on the 19th if you choose to tune in to that next webinar. Receive and review annual external reports, including the audit or review or compilation, depending on what your organization does, and the IRS 990 filing. Ensure that internal financial controls are in place to address your particular risks. And then finally, conduct a periodic risk review and mitigate risks where possible, including through the purchase of appropriate insurance. And that is